Okay, for the second part of Module 6, we are ready for Chapter 10, which is going to deal at least 80% with calculating bonds. And bonds are one of the more difficult topics in Accounting 101. So we're going to take plenty of time to go through these and hopefully make it as easy to understand as possible. Actually, journalizing the issuance of bonds isn't that difficult. It's finding what the bonds will sell for is the more tricky part. You have to understand that when bonds are made, they have to be given the okay because they're such a large dollar amounts that they have to be given okay by the SEC. They have to be approved. You have to have a lot of work done ahead of time to be able to put out bonds. You have to give financial statements forward or in the past and looking forward, what you expect to happen. You have to have a lot of documents, and then finally you print out the bonds. There could be a year gap between when you started to want the bond and when you actually got the approval and could start getting the bond sold. And in that gap, you had stated that you wanted to sell the bonds for this percentage because nobody's going to want to buy your bonds unless they're getting interest back. So you might have set 8%, but now it's a year later and the market is more like 10%. So then you have to decide, how am I going to sell my bond? Nobody's going to want to buy an 8% bond when they can go somewhere else and get a 10% return. The way to do that then is companies have to find the present value of their bond. And the present value deals with time value of money. And we're going to look at some charts that help us to determine the present value of what something is worth today at a discounted rate based on the amount of interest being different. All right. So when we look at bonds, companies issue them to raise money. It's a form of debt. So it's just you, instead of getting notes, these are just kind of a higher version of a note, a bigger amount a lot of times. Bonds, as I'd stated, bonds pay interest. Otherwise, investors wouldn't want to buy the bond. They don't want to just loan you money and then you pay them back with no interest. And so then the bonds are stated with an annual rate. And whatever rate they give, that's going to be the annual return on interest that you're going to get. Now, just because it says at the annual rate, most bonds pay semi-annual interest though. So what that means is if your bond says 10%, but it's a semi-annual bond, that means that just think of the formula I equals PRT. I equals, remember we did that just last time. Rate times time. So if we took the principal, it doesn't even matter what it is, but then you took the rate, 10%, times the time being 1/2 or half of a year. That 10% is really like paying 5% every single month or every single 6 months. So even though it's a 10% bond, that's what it pays for the whole year. But after 6 months, it only pays 5%, and then the other 5% the next 6 months. Now, when we're beginning to look at bonds in more detail, sometimes it starts to get confusing, seeing just all the different terms. You may want to make something like this. I make a little bond off to the side a lot of times where I'll put what's the market currently at, what's my bond currently at, what's the stated rate that I'm going to pay, how much is the bond really worth. So when they buy or when I pay them back, I'm going to be paying them back $1,000. And then the bottom, I always put, it tells me how often am I paying interest, and then how long is the bond good for, meaning I have to pay it back if I'm the one issuing the bond in 5 years. So I'm going to be paying, if I pay semi-annual interest, I'm going to be paying interest over 10 times because twice every year for 5 years. So this may help you. This kind of just gives me a real good snapshot instead of me having to read everything 2 or 3 times. I just put it in a little picture off to the side, put what the market rate is outside of the bond, because you still need that, but it's not actually part of the bond. It's used, this is going to be used to find how much do we sell the bond for. So when these two differ, when the 10% stated is different than the market rate, bonds will sell for either a discount or a premium. So in this case, in this situation, when the market normally is paying 9%, but mine's at 10%, I'm going to have, let's just pick a number, 50 people wanting to buy my bond. But I only have, let's say, one bond. So the market, the supply and demand, just like in economics, lots of people want my bond. So therefore, I can sell it for a premium. I can sell it for more than 1,000, even though I'm only going to give them 1,000 back, because they're getting a higher interest rate. Every time I pay them interest, they're willing to pay a premium. They may be willing to pay $1,050, even though I'm only going to pay them back 1,000 in 5 years. They're willing to take that $50 hit because they're going to get their money back through interest, a higher interest rate. Now, it could be the other way. It could be that the bond is only at 8% and the market's at 9%. Nobody would want to buy my bond. If I'm only paying 8% and they can go somewhere else and get 9%, who would want to do that? So what I have to do is then sell the bond at a discount. I have to say, okay, if you'll come and pay me $950, I'll only give you 8%. But when I pay you back this 1,000, when I pay you back for the bond in 5 years, I'm going to give you 1,000, not just the $950 that you paid me. So I'm going to give you an extra $50 to help offset that market rate difference. All right. So bonds can, if there could be a case where bonds and the market rate are the same. Then you can just sell it for face value. That's the easiest. And that's what we're going to see on our first connect exercise when we do that in the second part. That's the easiest one, when the bond sells for face value. So then the bond can sell for a discount, which means it's selling for less than the face value. Face value is 1,000. It's selling for maybe $950. We don't know until we do the calculation. Or the book could tell us that what the percentage is. It could say the bond is selling at 98. And all that means is the bond is selling at 98%. 100 being 100% full face value. And then whenever there's a difference, let's say we sold it for $950, that difference is called a bond discount. And what you have to do is think of bond discounts as hidden interest. Hidden interest meaning that extra $50 that they paid me for the that I'm going to pay them back, because they only paid me $950, but I'm going to pay them back 1,000 in 5 years. That's like an extra little interest payment that I'm giving them. And so a bond discount, we don't want to calculate all that $50 in that 5th year, because that would be a lot to go on our books when you're talking big numbers. So what I want to do is spread that $50 out over the life of the bond. And that's why we amortize it. And we've talked about that word. It's just like depreciation, except for non-tangible items, like this hidden interest. So that $50, we're going to spread it out. And you're going to see what I mean by that when we do an example here in a little bit. Bond premium is just the opposite. We're going to have our bond sell for more than what it's stated because our interest rate is higher than the market. We're going to create a bond premium, and then we're going to amortize it. So basically, it's like negative interest. The company is paying me $1,050 to get my bond, but at the very end, their interest is going to be, they're going to get back $50 less because I'm only going to pay $1,000. So over time, I'm taking away a little bit of the interest that they're getting paid. Again, you'll see what I mean. Now, bonds, the book could make it easy for us, and they will on some of them. They're just going to give you a number, a 102 maybe, or a 105. And that means that that's what the bond is selling for, 102% of its purchase price. All right, let's start off with an easy one. The easy one here just basically says that the bond is selling for face value of $50,000. And if we wanted to, we could make, I think I'll do this. I'm going to make this little thing down here just to kind of get used to doing this. I think it helps. All right, I'm going to bring everything down so it's easily to see. All right, we got a bond value of $50,000. and it's selling at face value. So that means that the market and the bond rate are the same. They're both at 9%. So let's put in those amounts that we know right now. We've got a 9% bond, market rate 9%. This is 50,000. And it tells us that the bond is paid semi-annually, and the first interest payment is in 6 months because we sold it on 1/1. First is June 30th. And let's, what says here, record the issuance of the bond and the first interest payment. I don't tell us how long the bond is because on this problem it doesn't really matter because there's nothing to calculate. There's no, we don't need to calculate full interest payments or anything like that. As we get further, I do put those in. So this one, we'll just assume it's 5 years just to make it easy. So we got a $50,000 bond. So our first journal entry is simply going to look like this. We're selling the bond, so we get the upfront cash because we need the money to build up the business. And then just like we would put on any other liability, like a note or an account payable, but this is just like even longer term, we have a bond payable. Bond payable shows that we owe $50,000. And then when we come down to 630, now we're going to show that we made our first interest payment. And we can calculate our interest just by doing the formula P equals PRT. So we take, let's move this back a little bit. We take the 50,000 principal times 0.09 times half of a year. We can easily do that. Let's bring that here. We've got 0.09 times 0.09 times half times 50,000. We get the interest to be $22.50. So at the end of June 30th, I need to pay my bondholders $22.50 as a thank you for loaning me the money. And then in December 31, I'm going to pay you another $22.50. And then after 5 years of paying you $22.50 twice a year, I'm going to pay you back your whole $50,000. So it's a pretty good deal for you. You're getting monthly payment or semi-annual payments. So you can see here, this isn't too difficult. We've kind of already done these in prior chapters when we calculated our interest. Now, this one is just a little bit more detailed because this one I tell us that we're not going to issue it at face value. We're going to issue it at 97 instead of full value. So you don't actually have to calculate. You can just do the simple math to figure out what the bond sells for. Bond sells for 97% of 50,000. So if we take 50,000 times 97%, we get 48.5. So when I go and issue the bond, I'm going to show that I have cash coming in of 48.5. Now the bond shows that I will pay it off at 50,000. Now the reason why it's selling for cheap or cheaper is because I had to issue it at a discount. Because in my problem here, the bond is stated at 9%, but the market is willing to pay 10%. So therefore, people aren't going to want to buy my bonds at face value. I have to give them an incentive. I have to give them, basically, I'm giving them $1,500 in 5 years, an extra $1,500, because they're only paying me $48.5 now, but in 5 years, I'm going to pay them that much and an extra $1,500. So remember, this is like hidden interest. So what I'm going to be doing now, when I get down to 630 to pay my first interest payment, I'm going to begin to take away, I'm going to amortize over straight line method. That's what the problem tells us to do here. We're going to straight line it, determining how many payments am I going to have. Well, if I pay semi-annually and I pay it over 5 years, that's 10 payments. So I need to break this down equally in 10 parts and get rid of my discount a little bit at a time. I don't want to get rid of all $1,500 when I pay off the bond. So how I'm going to do this is the first thing I'm going to do is figure out what is the interest expense. The interest expense is actually what the market rate is. The market rate is 10%. We always put interest expense at what the market is. So our interest expense is the 50,000 times 10% times a half a year. So if you do that on the calculator, it comes up to be $2,500. Now, even though that's $2,500, that's not what I'm paying to my bondholders. It's stated that they only get 9%. But you think, hey, wait, you calculated 10. Well, there's a reason for that. What I'm gonna, and my numbers here weren't quite correct. This actually, this should have been, if I was doing this correctly, and I think I'm gonna go ahead and change it. Yeah, I'll leave it. But this really should have been at 95. If I was doing the actual full out calculation, I just guessed and put it at 97. But now looking at the numbers, it should have been 95, and this should have been 47.5 and 2,500. Because when I go to discount this, that should be 2,500, and then taking 10% of that, because I want to amortize it evenly. That's going to be the 250, where the 250 comes from. But this is the other way of doing it. This is saying, okay, what I actually paid my bondholders was 9%, not 10. So my credit here is cash of $2,250. And then to get these two to balance, I have to show that I'm getting rid of this hidden interest, and I'm putting it in here. I'm taking away $250 of the hidden interest, and I'm putting it here as actual interest. I'm uncovering it. It was hidden before, and now every time for the next 10 payments, I'm uncovering that interest. That's how I think to look at this. Okay, let's do one the other way. Let's look at how it's just almost the same, but just having a different, instead of a discount, we're now going to show a premium. Same thing happening, except now our bond sells at 105%. Because the stated rate, what's on the bond, is I'm paying 11%, not 10, or not 9, but I'm paying 11, and the market is 9. So I'm paying more than what the market says that it's willing to bear, what other people are going to pay. Okay, so let's look at how I got my answers. First, I put how much cash are we getting? Well, we're getting 105% of the 50,000 because it was issued at 105. And then I show that my credit, my first credit is, well, I'm going to credit my bond payable because I'm going to pay them back not 52.5. They're paying me a premium. I'm going to pay them back only 52,000 or 50,000. The difference is that $2,500, and that's the premium. They're not going to get that back. But how they're going to get that back is by me paying more interest than what the market is willing to pay. So that it kind of is a wash at that point. So when I go down here to do my journal entry, I go down and I calculate the interest expense at actually a lower rate than what I'm actually paying. The interest expense now is at 9% because that's what the market is in my problem. The market's 9, so that's what I have to show my interest expense, even though I'm paying out 11%. So I'm paying out $2,750. The difference here, the premium on bonds payable, is I'm amortizing this over the 10-year rate. And so really the number I had, again, was slightly off. I just guessed and put 105. It really should have been, it looks like 110. It should have been 55,000 because I'm taking 500, which would be 10% of the 5,000 different if I sold this for 55. Again, don't get caught up in that. But the main point here is I wanted to show you how the premium of the bond payable looks. Notice on the other one, the discount was a debit, and then we added it in as a debit. Here, when it's a premium, it's a credit. All right, now we're going to kind of that's kind of the intermediary step where they give you an amount. It's not quite the face value, but they give you like 102%, or they'll actually tell you what the bond sells for. The hardest thing about bonds is actually finding the bond selling price. And when you need to find the bond selling price, this is why I put these tables in the learn area. So the tables, there's 4 of them on here, and the book will give you 4 choices as well when you get into problems. But we're only going to use 2 of them. We don't need the future value. If you pull up any charts that say future value from the Connect exercises, you might as well just take them back off. You don't need them. We want to have the present value of $1, and then we want to use the present value of an annuity. Those are the 2 charts that you're going to need to have to calculate how much a bond sells for. So I would go ahead and get those up if you don't have those already, because you're going to follow along. All right, so to find the bond selling price, we need these tables. We only need 2 of them. And I've broken it down to where there's a 3-step method to get these. And the book actually does very similar to this as well. So that was good to see. It should be a really easy transition to when you do the Connect exercises. So the first thing you're going to do is find the present value of that bond right now. And what I mean by that is that if I'm selling a $50,000 bond, that means I'm going to give back my bondholder 50 grand in 5 years. 50 grand in 5 years is not the same as 50 grand right now. And the interest payments, I'm going to be giving them interest payments over the next 10 years or the next 5 years, twice a year. If I give them $100 of interest this year and another 100 at the end of this year and then another 100 all the way for 10 more times, that's all those hundreds aren't the same value, because $100 3 years from now is not the same as getting 100 today, because you can earn interest with that. And that's what the time value of money tables are going to be used for. Okay, so before we can use these time value of money tables, we have to first know the terms of N and I. N, these are your periods, and that's basically telling me N being how many times is interest paid. So even though it may be a 5-year bond, if it's paid semi-annually, then you come down to 10, because it's 10 times the interest is paid. So number of years times your payments in 1 year. So if we had 5 years times 2 payments in a year, that's 10. And then interest is just the opposite. If it's giving you 8%, but it's paid twice a year, you take the 8 and divide it by 2, and you get I is 4, if you had that example. So we're always going to be using N and I as we go through these. And we're going to put some numbers to these as we go along. So the first thing we would have done is calculated the face value of the bond, present value. Then we're going to find the present value of all the interest payments. And what we have to do with that is the main thing is we have to find the value of the interest that the bond is paying out every single 6 months. So we would have to done that anyway to see how much we had to pay our bondholders. It's just we have to do that up front now to figure out how much are we paying them. And then take that and find the number on the chart. And then once you've done steps 1 and 2, then step 3 is the easy one. You just add the values of step 1 and 2 together, and that's what your bond is going to sell for. All right, a lot of that is hard to understand. Let's go through this and see if we can make it a little less complicated. So the first thing I'm going to do here is I'm going to copy this again. I'm going to make a little bond. All right. So the market rate, it tells us it is 8% and the bond is at 6%. This is 8 and the market rate was, nope, other way around. This is 6 and this is 8. So the market is going to pay more than what I am. That means I'm going to have to sell my bond at a discount. And our bond is $1,000 due in 5 years, paying semi-annual interest. And we're going to decide then how much do I need to sell my bond for. So one of the first things I'm going to have to do, remember, is figure out what my normal cash interest is going to be. Simply take what my bond is worth, the principal, times the rate, what I'm paying, 6%, times semi-annual, half a year. So that comes out to be 30 bucks. Now we can start doing the 3 steps from above to figure out how much do I need to sell my bond for exactly, so nobody is out. I'm not selling it for too cheap, or the bondholders aren't getting ripped off either by getting a lower interest rate and paying too much for it. Okay. So the first thing we need to do is figure out our N and I, our number of payments. So again, it's 5 years. And 2 payments a year, so that's 10. So our number of payments is 10. And then our I, we take whenever you do I, you always use the market rate. That's the only time we're going to use the market rate. So we're going to have I is 8% divided by 2 payments in a year. So we're going to use I is 4. So whenever you do the charts have to use the market rate. That's the only reason you're given the market rate. We're not going to use the market rate for anything else. All right, so let's do the 2 steps. Step 1, find the present value of the bond. All right, so what we do is we go to our charts, find the one that says present value of $1. That's of a lump sum. And that's what that 1,000 is. That's just a one-time payment. Go to 10 in. Go to 4%, our I was 4, 0.676. So I'm just going to take the lump sum times that number, $676. That's what 1,005 years is worth right now today. And we can get way more into that. That would be a whole nother class session as to proving that and how that all works with the time value of money. But for right now, you'll just have to trust me on it. 676, that's step 1. Now we're going to do close to the same thing, but we're going to do it based on the interest payments. The interest payments is not just a one-time payment. It's little payments for 10 different times. So that means we have to use a different chart. So we're going to use the present value of an annuity chart. Same N, same I. N is 10, I is 4. All we've got to do is go back up and remind ourselves what the interest payment semi-annually is, and then take in and 4% on the second chart, and that's 8.111. So take the $30. I already calculated this when we were up higher, so I already knew it was 30. 30 times the 8.111. And that comes out to be what the present value of all of those interest payments are. When you add these 2 together, this is what my bond needs to sell for. Notice it's close, but as it should be, it's below the 1,000. I'm giving my bondholders a discount. This is what I'm going to sell my bond for when I market it. It's going to be a $1,000 bond, but you can buy it for $919.33. Now we're ready to do the journal entries. You can read through these in my notes. Again, it's just explaining why bonds are issued at a discount. I've tried to do that as we went along, but maybe we'll refresh it a little bit more. Let's look at the journal entry here. Our cash, that's what I'm selling it for. Discount is the difference between what I sold it for and what its face value is. How much off did I give them? Again, think of this as hidden interest, because I'm going to pay them back the full 1,000, even though they only gave me $919. So they're going to get an extra bonus of 80 bucks. But instead of showing that bonus of 80 bucks all at once in 5 years, I'm going to divvy it out a little bit at a time so it doesn't hit my books real hard. All right, so let's look at how the journal entry is. The interest expense, we always want to calculate this on the market rate. And we could have done this, the best way is to get these two amounts first and then plug in the interest, but we wouldn't have had to. It's going to be close. If we go back up here to what my bond, if I look at my bond, it's a 8% rate. So if I was to calculate the interest expense, the interest expense is basically going to be how much cash did I have to pay, plus how much hidden interest am I exposing. I'm exposing $8.07 this time because I want to slowly amortize that $80 difference. So when I do that, if I take the $80 difference and divide it by 10 payments, because we're having 10 interest payments, that's $8.07. So these two together, so my interest expense isn't just 30, it's 30 plus a little bit of that 80. So instead of me having on that very last payment that I have to make 30 bucks and then another 80 bucks as interest because I'm paying them back more than what they paid me, I'm putting that 80 just a little bit in every single payment. So not 1 year has a whole bunch and then all the other years have nothing. So that's the whole reason we do it like that for interest. And then as we go on to, this would have been for June 30th, every single payment is going to be the same when we use the straight line method. The straight line method meaning the $8.07 stays the same. I continually use the $80.67 and divide it by 10, just like doing straight line depreciation, stays the same. And then by the time we get to the 10th payment, my entire discount is gone away. Because if you were looking at a T account, I had $80.67 as a debit in that initial T account up here. Remember, it's an $80.67 debit. Well, and when I get rid of $8.07 as a credit, now this is what my balance would be after the first payment. After 2 payments, my balance is continually coming down. And by the time I hit that 10th payment, I'm going to have 0 left. And that's what I want. I don't want to have any discount left on my bond. I just want to pay off the bond in full, that full $1,000. Even though I only got $919, I still have to pay back $1,000. But I've planned for it by putting in an extra $8.07 as an expense every year. Okay, I know you might have to go back and watch that a couple times. That is a very complicated section, but just it will sink in. It just takes a lot of practice, and you'll get that. They give you a lot of practice in Connect as well. The last part of this I wanted to touch base on was leases. The difference between an operating lease and a capital lease, because leases are, you have something and then you have to pay for its use. Think of you just as renting your apartment. It's not your apartment, you're leasing it. So you're constantly having to pay payments. So a normal operating lease would be like for your car or for your apartment. You're never going to own it, and it's not yours. And especially if it, now I'm not talking about making car payments. That is, you do own the car and you're making payments back to the bank. A lease would be when you lease it from the dealer for like a 3-year period and you have no intention of keeping it. So that's what a normal operating lease is, and you simply record it pretty much like you would think. You record, if you're the leasee, you're the person who's using the apartment. You just simply show that you have a rent expense and credit your cash. And it'd be just the opposite if you were the landlord. You record the cash and credit rent revenue. So operating leases are the easy one. It's where we come into a capital lease, and this I need to change the term. Capital lease is a little bit different. For accounting purposes, you record capital leases like you've actually purchased the item. Because what a capital lease is, and we don't cover it in this at this level, but when you get into intermediate accounting, should you keep going in accounting, you're going to see that capital leases, you'll know it's a capital lease by either how long you will have it versus the useful life. So what I mean by that is if you have a machine and the machine is known to really only be in good condition for 5 years, after 5 years it's out of style, it's out of date, whatever it is. And if your lease is at least 4 of those years, then when the company takes it back, or if they ever do, it's basically like you owned it because you had it for its entire life or almost all of its life. The other way that it's a capital lease is if you end up paying for almost all of it, meaning the company paid maybe $100,000 and then you're leasing it from them at $10,000 a year for 10 years, you're basically paying for the whole thing. So that would be considered a capital lease if you've either owned it for most of its life or you've paid for most of it, if not all of it, in present value payments. So when you have a capital lease, you have to treat the situation different. First, you actually record it like you bought it. You debit equipment and you credit this payable account, this liability account, this lease liability. And you're going to record it at, note here, the present value of all of your lease payments. We just talked about present value when we were talking about bonds. What is that? What are all those payments worth right now that you're making over the next 10 years, if that's how long you're paying for this lease? So you're going to use the tables to figure out what is all of those worth in 10 years. And then just like when you buy a machine, you're going to depreciate it just like it's yours. And you're going to expense out the cost of that equipment. Instead of expensing out the payments that you make, because you're not going to call it a rent expense, you're going to actually be owning it. You're going to show that it's an expense by actually using it and depreciating it, just like you would have bought it. Okay, so I got my example here. We're on the first day of the year. We have a 3-year capital lease, so I go ahead and tell you it's a capital lease. Otherwise, if it's just a normal situation and you were in day-to-day life, you would have to make that determination. Is this a capital lease or is this an operating lease? So the capital lease on our equipment, and we're making monthly payments of $100 a month for a total of $3,600. So hopefully you see where I got that. $100 a month for 12 months is $1,200. For $1,200 for 3 years is $3,600. So that's how much we're paying. Interest is 12%. The present value of the lease, so I went ahead and did the calculation for us. I wouldn't have had to, but I think the book does it for you anyway, so I went ahead and did it too. You could have figured it up by using the present value of the annuity. You could have said, okay, my interest, remember your interest, we wouldn't use 12% because we're paying every month. So it would be 12% divided by how many payments in a year. So 12 divided by 12 is 1. We're making 36 payments. Oh, this is why I did it like this. Is our charts don't have 36, it has 35. So I had to use a number close to 29, but just a little bit more because we're heading towards 40 if we're at 36. So I picked like 30.1, and that's how I got this $3,010 amount. It's close, it's probably not exact, but it's probably within 15 bucks So now when it's a capital lease, remember, I'm going to debit the equipment just like I own it for the present value, and I'm going to credit this lease liability. And we could call this anything we really wanted. This is just kind of a very generic term that shows that, yeah, it's a liability. I'm going to need to make payments of at least $3,010 over the time. Now, you're going to say, hey, wait, I thought you had to make payments of $3,600. I did, but this is just simply the note part. This, the whole part, includes interest and note. So this is just the bare bones note. This is what I'm going to be paying with interest. So now I can start making my my payments, and to do that, going back to our last session in chapter 9, when we made this amortization table, I want to then figure up how much of my $100 payment goes to my loan, the 3,010, and how much of it is interest. So then we do I equals PRT. So I take the P, principal, 3,010, times the rate, 12%, times the time is only 1 month. So let's do that. Let's do 1 month times 12% times $3,010. I got interest of $30.10. And then if I pay 100, the first $30.10 goes to interest. That means the rest goes to the note. And if it goes to the note, then it brings down what I owe on the note by $69.90. So that's all I did to get this new number. Now let's go ahead and do it one more time, and then we'll do the journal entries. Let's figure out what payment 2 is. Payment 2, the interest, the cash is still going to be the same, 100, but the interest is going to be slightly less. Let's figure it up. We got 1 over 12 times 12% times 29.40 and 10 cents, because that's our new value of the note. So my interest is now $29.40. That little extra goes to the note. A little bit over time starts adding up. Now we can do my my journal entries. These over here are going to be my 2 debits, cash being my credit. So a lease liability, my note, the value of that note goes down by $69. The rest is interest, and full payment of $100. And then you can see what it looks like. It's the same setup, just with a couple of different numbers for my debit, my 2 debits, and then my credit stays the same at $100. All right, that concludes our lesson here on interest. And we will now go into our Connect exercises.